Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two top-ranked surging tech stocks to consider buying before their upcoming earnings releases. And those two stocks are Arista Networks, which trades in the ticker ANET, and Robinhood Markets, which trades in the ticker HOOD, HOOD. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into Arista and Robinhood, which are two Zacks Rank #1 strong buy stocks to consider buying before their upcoming releases, I quickly just want to go over where the market stands just real fast to put these two stocks maybe in a little bit better of context. So as I'm recording this on Thursday around midday, overall, nothing has really seemed to shake the bulls from their kind of autopilot chop to start the year. And there's a chance the market keeps moving sideways until we make it out of earnings season. So far, the line in the sand the bulls continue to hold is that 50-day moving average, which is somewhat near that post-election gap higher. So that's kind of where the market's chopped around for the last several weeks, which is actually not a bad start to the year. We were due for a cool-off after that massive post-Trump election rally and the big 2-year run over the last 2 years. And it's even more impressive that despite all of the wave of tech earnings, the tariff back and forth, the DeepSeek news and beyond, that the S&P 500 and the NASDAQ have continued to find support at that 50-day moving average, and really nothing shaking the bulls from holding the line at the moment, which is a good sign. So the big data that will be out, as you probably listen to this at some point in the next few days, is the January jobs data, which is due out Friday morning. So at this point, the jobs market is projected to slow. The U.S. economy is expected to add around 170,000 jobs in January compared to 256,000 in December, while unemployment is expected to remain flat at 4.1%. So overall, the economy remains strong, and all the earnings results so far overall have been relatively bullish. So that's kind of where the market stands at the moment. We've had some chop to start the year, which is a good sign to let things cool down. And overall, the bulls are still in control. So with that in mind, we're going to take a look at the first of our two top-ranked tech stocks to consider buying heading to earnings, and that is Arista Networks, which trades on the ticker ANET. The company is set to report its Q4 results on Tuesday, February 18th. So overall, ANET stock has ripped higher over the past 12 months, tripling the Zacks tech sector. It's up 75%. This is part of an even stronger run over the last decade, yet it's now trading 10% below its highs following its DeepSeek sell-off. The company also completed, it's worth noting, a 4-for-1 stock split back in December, which helped make its price per share more attainable to a larger swath of investors and more appealing to traders. So as I record this, ANET is trading at roughly $116 per share. So let's dive into a little bit more of the company. So Arista Networks is a client-to-cloud networking powerhouse concentrating on large AI data center, campus, and routing environments. Its network infrastructure has expanded rapidly over the past decade alongside cloud computing and the big data explosion, and now the AI and big data networks to support the AI revolution is the biggest new kind of gust of wind at ANET sales. It boasts over 8,000 cloud customers worldwide, including some big Magnificent Seven tech companies. Microsoft and Meta are actually two of its biggest clients. In 2023, Arista Networks said that its Cloud Titan customers accounted for 46% of its revenue, which is a big vote of confidence from two of the biggest tech players in the world. So that's something Wall Street loves, that Microsoft and Meta are relying on Arista Networks' various offerings. And Wall Street views that growing relationship as pretty healthy, and as I said, kind of a vote of confidence in how important in high-tech Arista Networks offerings are. So 13 of the 19 brokerage recommendations that Zacks has for the company are strong buys. And we should note that the growth of the company has been really impressive over the last decade. So it grew from around $360 million in sales in 2013 to nearly $6 billion in sales in 2023. Averaging 37% sales growth in the past 3 years. So looking ahead, Arista is expected to grow its sales by 20% in fiscal 2024 and then another 18% in 2025 to get up to $8.2 billion. The network infrastructure firm infrastructure firm is projected to grow its adjusted earnings by 26% in 2024 and then another 10% next year. Or I guess at this point now it's 2025, so 10% this year. And this comes after 52% bottom line expansion in 2023. So continued growth on the bottom line is a good sign, since its valuation is a little, a lot higher than the broader market, which we'll get to in a moment, in tech. Overall, its improving earnings estimates help it land a Zacks Rank #1 strong buy, and it's topped our quarterly estimates for 5 years in a row, including a 15% average beat in the past 4 quarters. And its estimates have really just soared over the last 5+ years. Its outlook for 2025 and 2026 have climbed significantly over the last year as well, which is a great sign. And its most recent / most accurate, or its most accurate estimate came in 9% above the current consensus for 2025. So overall, this helps it land a Zacks Rank #1 strong buy at the moment. So just continued bottom line earnings revisions heading in the right direction. This backdrop is why the stock, though, has skyrocketed this past year, in the last 2 years as well. It's up 245% in the last 2 years and 45% in the last 6 months alone, blowing away tech and the market during both those stretches. And if we look over the last decade, it's up around 2,800% in the last 10 years, blowing away Meta and Microsoft, which are both up around 850% during that stretch. And tech is up 320%, while ANET is up, as I said, 2,800% in the last 10 years. The stock did tumble off the DeepSeek news like a lot of other AI industry stocks, but it found buyers relatively quickly. It's back above its 50-day moving average and trading around 10% below its January peaks. It found some support at some previous highs from earlier this year, back in October. So that's where it found buyers stepping in at some previous highs before it jumped up in the last several months. So it's now trading 10% below its all-time highs, and it went from heavily overbought RSI levels to, in the blink of an eye, to below oversold, and now it's trading at roughly neutral RSI levels here at the moment. And if we look on a longer-term basis, it's still trading solidly above its 21-week moving average. So it could possibly pull back to that longer-term trend line, or maybe even the 50-week. So if you're a trader or investor who wants to kind of get into stocks at maybe a bit more of a advantageous time and try to actually time stocks, maybe you want to wait for a pullback to, say, the 21-week or the 50-week or the 200-day, because at some point it's going to probably face a little bit more profit taking, but it's never clear if it's going to happen right after earnings or when that's going to come. So that's why getting in and out of stocks and trying to time things exactly is so difficult, especially for these strong growth names like Arista Networks, which could continue to glow up for years and years to come. And it's also worth noting just quickly why Wall Street was so quick to buy up ANET and other of these AI stocks that were hard hit after the DeepSeek news. First, the soaring artificial intelligence ecosystem stocks were due for a healthy recalibration, so it was good to kind of have that happen all at once. And the massive one-day sell-off helped blow away a ton of the froth. As I said, it was at super overheated RSI levels and kind of washed away, in some cases, 6 months worth of gains in the blink of an eye. The sell-off also offered the chance for investors to kind of buy stocks they might have missed out on, such as Arista Networks, at lower prices. So that's why you saw some investors step up relatively quickly. And second, which is more important, is that Wall Street and the biggest technology companies in the world who are investing hundreds of billions of dollars in AI are unlikely to be proven completely wrong. So investors kind of quickly ask themselves if NVIDIA and Meta and Microsoft and all of these other companies are going to be proven totally wrong just because a company that very few people had heard of until a few weeks ago claims to have changed kind of the entire AI industry overnight. So that's why you've seen the bulls step in and start buying up some of those hard hit AI stocks, including Arista Networks, which is still trading 10% below its highs. On the valuation front, this is what's holding back the stock long term. It's never been a value stock. It's traded at a premium to tech for the whole entire past decade. It's currently trading at a 52 times forward earnings, which is way above tech, which is trading at about 26 times forward earnings. with a price to earnings to growth ratio, so a PEG ratio of 3.1 versus tech's 1.7. So still very, very pricey no matter how you look at it in terms of valuation. But investors have been willing to pay up for Arista because its performance has been huge and its growth on the top and bottom line has been really consistent. And it's also worth noting it has a really impressive balance sheet, about $7.4 billion in cash and equivalents, about $13 billion in total assets versus just $3.6 billion in total liabilities and zero debt. So Arista Networks, certainly a stock to consider looking into, heading into its earnings release. Maybe you want to wait until after its report to see if it has a possible longer or larger pullback, but it's already 10% off its highs, and it's a Zacks Rank #1 strong buy at the moment. And now we're going to transition to Robinhood Markets, which trades on the ticker HOOD, HOOD. The stock has skyrocketed about 390% in the last year in a bid to return to its all-time highs, which it hit following its 2021 IPO. The company reports its Q4 results on Wednesday, February 12th. So let's kind of dive into all things Robinhood. So Robinhood is a registered broker-dealer that burst on the scene by appealing to young investors and newcomers to the stock market. It transformed into a widely popular trading platform during the initial COVID market rebound and the subsequent bull run. Since then, it's rolled out retirement accounts and credit cards and broader trading platforms, including crypto. So let's just go into some more recent things as well. So in November, the company announced it was getting into wealth management, that it struck a deal to buy Trade PMR, a financial company that provides custody, technology, and portfolio management tools to registered investment advisory firms known as RIAs. So they're getting into the wealth management business. They're also trying to roll out cheap robo-advisors. So they're really bolstering their entire business. And then we should note that in mid-January, Robinhood said it will pay about $45 million to the SEC to settle various violations and as well as some data breach things. So that's good that that's now behind them. It's become overall just much more than a free stock trading app. Back in October of 2024, the company said it began rolling out its Robinhood Legend, which is a powerful kind of browser base, so not just on your phone, desktop trading app built for active traders, which is a good thing. So it's really appealing to now more than just kind of people thought of Robinhood as like, oh, some 22-year-old on their phone just kind of picking and choosing stocks and they'll be off the platform sooner than later. But it's now trying to compete with a lot of these bigger brokerages like Fidelity and various other competitors like that. And its growth has been really impressive. So its monthly active users increased 7% year over year in Q3 to 11 million. And looking ahead, it's projected to swing from an adjusted loss of 61 cents a share in 2023 to positive 97 cents per share in 2024, and then add another 22% to the bottom line. And its top line growth is really impressive as well. It's expected to grow 54% in 2024 and then another 23% in 2025 to get up to about $3.5 billion versus $1.9 billion in 2023. And Wall Street's really rewarded the stock because its earnings revisions have soared over the last year plus. Its revisions for 2025 and 2026 and 2024 have essentially just gone kind of straight up over the last year plus. And over the last since its Q3 release, its 2024 estimate's up 21%. Its 2025 estimate is up 20%, and its Q4 estimate is up 64% since its Q3 release. So that's just going all in the right direction, which is a big part of the reason why Robinhood shares have skyrocketed, as I said, around 390% in the last year, including a 210% run in the last 6 months. So it's gone on a massive run. It's currently trading right near its 52-week highs, well above its 21-day and 50-day moving averages, and trading at some overbought RSI levels, but it's kind of been there for much of the last several months. So if they have a great quarter, we could see the stock break out to its all-time highs. It's kind of finding some resistance right now at near its 2021 peaks, its all-time peaks. It went on a massive kind of short-term run to peaks nearly at $80 at one point intraday, but it's sort of topping out right now at its all-time highs from 2021. So we'll see if you look at a technical chart, you can kind of see that it went on a massive little burst up to over $80, and now we'll see if it kind of sustain a run to above its real highs from 2021 in the coming days and weeks heading into and after its earnings results. But I would expect at some point that it's going to have a little bit of a pullback since it's up almost 400% at the moment. That said, though, despite this massive run, it's trading at a 50% discount to its highs in terms of forward earnings over the last year. It's still a little pricey. For most people, it's trading at 44.9, so we're up 45 times forward 12-month earnings compared to its finance sector, which is trading at 17 times forward 12-month earnings. That said, its PEG ratio, which factors in its longer-term earnings growth outlook, is at 0.7, which is a massive discount to the finance market, which is at 1.3. So it shows that its earnings growth is there and it's backing up the stock, and it's a really big reason why Robinhood has gone on an impressive run. Wall Street's still pretty high in the stock as well. It's gained some attention. It has 2 more brokerage recommendations today than it did 3 months ago, and 11 of the 19 brokerage recommendations that we have here at Zacks are at strong buys with no sell ratings in there at all. So Robinhood, certainly a stock worth putting on your radar heading into its earnings results. As I said, playing any of these stocks for just a big post-earnings gain is very risky, especially for a stock that's gone on such a big run over the last year. But the company's really improved its business, and it's showing that it's not just kind of a COVID one-hit wonder of people who are no longer trading, and it's now going to be a big kind of player in the broader brokerage world with Fidelity and many others for possibly years and years to come. So both Robinhood and Arista Networks are Zacks Rank #1 strong buy tech stocks that are both worth considering putting on your radar heading into their upcoming earnings releases. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over our podcast at zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.